Even though there is a lot of volatility in the stock market, following some tried and true guidelines can help investors increase their chances of long-term success. Some investors sell their valued shares to lock in profits while sticking onto their underperforming stocks in the hopes that they would turn around. But strong stocks have room to rise further, while weak stocks run the risk of going fully negative. In this video, we will inform you about tips for smart spending, stock market deep dive, mastering stock investing. So please watch the video from start to end. Therefore, let's get going. 1. Understanding successful long-term investing. Ride a winner. If he believed there was still significant upside potential, this required the self-control to hold onto equities even after they had appreciated by a significant amount. The lesson is to not hold to arbitrary standards and to evaluate the stock according to its own merits. 2. Sell a loser. Being realistic about the possibility of underperforming investments is vital, because there is no assurance that a stock will recover after a protracted slump. Furthermore, while admitting to losing stocks may psychologically signify failure, there is no shame in making corrections and selling off holdings to prevent additional loss. In both cases, it's crucial to evaluate businesses on their own merits in order to decide whether a price is reasonable given the possible upside. 3. Don't sweat the small stuff. It's better to follow an investment's long-term trend than to freak out over its short-term fluctuations. Have faith in an investment's bigger picture and resist the urge to be influenced by volatility in the short term. Don't overstate the few pennies you might save by using a limit order as opposed to a market order. Yes, savvy traders employ minute-to-minute variations to secure profits. However, long-term investors are successful during periods of 20 years or longer. 4. Don't chase a hot tip. Never take a stock suggestion at face value, regardless of the source. Before you invest your hard-earned money, always conduct your own research on a company. Depending on the credibility of the source, certain tips can be profitable, but thorough investigation is necessary for long-term success. 5. Pick a strategy and stick with it. There are numerous approaches to stock selection, so it's crucial to adhere to just one style of thinking. You become a market timer when you alternate between various strategies, which is risky ground. Consider how renowned investor Warren Buffett avoided the dot-com boom of the late 90s by adhering to his value-oriented strategy, avoiding significant losses when tech businesses failed. 6. Don't overemphasize the P/E ratio. Price-earnings ratios are frequently given significant weight by investors, but focusing too heavily on one statistic is unwise. The ideal way to use P/E ratios is in conjunction with other analytical techniques. As a result, neither a low P/E ratio nor a high P/E ratio imply that a security or firm is inherently cheap or overvalued. 7. Focus on the future and keep a long-term perspective. Making educated judgments about future events is a requirement of investing. Although historical data can predict future events, this is never a guarantee. Peter Lynch wrote in his book, One Up on Wall Street, from 1989, "If I'd bothered to question myself, how can this stock possibly go higher? I never would have purchased a Subaru when the price had increased by a factor of 20. However, I looked at the fundamentals and saw that Subaru was still inexpensive. I bought the stock and immediately earned a 7-fold profit." It's crucial to invest based on perspective rather than past results. Although significant short-term gains can frequently lure market novices, long-term investing is crucial for higher success. Additionally, while short-term active trading can generate profits, there is a higher risk involved than with buy and hold tactics. 8. Be open-minded. Many great companies are household names, but many good investments lack brand awareness. Furthermore, thousands of smaller companies have the potential to become the blue-chip names of tomorrow. In fact, small-cap stocks have historically shown greater returns than their large-cap counterparts. From 1926 to 2017, Small cap stocks in the US returned an average of 12.1%, while the Standard & Poor's 500 index, S&P 500, returned 10.2%. 3. This is not to suggest that you should devote your entire portfolio to small cap stocks. 9. Resist the lure of penny stocks. Some people wrongly think that equities with lower prices have less to lose. However, if a $5 stock crashes to zero or a $75 stock does the same, you've lost all of your money. Hence, the downside risk is equivalent for both equities. Because they are frequently far more volatile and have less regulation than higher-priced companies, penny stocks are actually probably riskier overall. 10. Be concerned about taxes, but don't worry. Investors who prioritize taxes may end up making poor choices. Tax ramifications are significant, but investing and safely growing your money come first. While you should work to reduce your tax obligations, getting large returns should be your top priority. 11. Setting goals and strategy. One of the first stages to accomplishing your financial objectives, whether you want to become financially independent or save for your first house, is to know exactly what you want to receive out of investing. It's crucial that you specify your objectives in concrete words. Instead of making a general statement like, "I want to build a large investment portfolio," you could set a specific objective like building a $150,000 investment portfolio to use as a deposit for my first home purchased in 4 years. It's crucial to develop a plan for achieving your goals after you've identified them. Considerable suggestions include creating a budget, cutting back on wasteful spending, or finding new sources of money. Last but not least, it's crucial to frequently measure and analyze your progress because most people's financial situations and objectives will change over time. Your unique situation will ultimately determine whether this entails increasing your savings, cutting back on your expenditures, or even changing your ambitions. 12. Choose an investment platform. It's time to select the investment platform that is best for you after you've outlined your existing situation and determined your investing objectives. What kind of investor you are is the most crucial factor to take into account when selecting an investment platform. Do you wish to trade more regularly and be more active? Or do you prefer to trade less regularly and be more passive? Is it more necessary for you to do it yourself, or do you want assistance and direction so you can invest with confidence? Answering this question will be crucial because less active investors may not need many of the features and capabilities that active investors need, and vice versa. 13. Smart basket investing. For people who wish to use the expertise of Sykes Wealth Advisors while aligning their assets with their investment goals, smart basket investing is fantastic. It's also fantastic for someone who understands how crucial it is to take charge of their financial destiny, but may not have the knowledge or time to do so in a direct, hands-on manner. That concludes today's video. I sincerely hope you enjoy this video. If so, please subscribe to our channel and click the bell symbol to see more. Enjoy your day and thanks for watching.